let's see. Lana, heavy drinker. I see her there. Hutch claims he wants to have a meeting with me. So Hutch is interesting. He's with a group called
I know Hutch. He's my buddy. Yeah.
So Hutch and Heath swear they want to have a meeting with me and talk about setting up something. But the only way they contact me is through LinkedIn. And if anybody knows me, there are two things I don't do. One is answer my phone, and two is ever respond on LinkedIn. And so I responded to Hutch. He's not listening right now, obviously. I responded to Hutch on LinkedIn saying, please email me a time. And so what does he do? And I gave him my email address. He responds on LinkedIn.
He's not winning friends and influencing people. That's for sure. Come on, Hutch.
The kids these days. And then they
just don't make them like they used to.
Yeah. Trevor's hanging out. I'm not going to call him out yet, but
yeah, I see Trevor.
I was hoping he was going to be standing in front of a vault that was filled with lots of money.
Dollar bills. Yeah.
With no reserve requirements and best interest rates and maybe a horse with a carriage behind it, something like that. Trevor, we're going to let you on if there are any questions. Definitely want to introduce you to the group. Let's see. Sheila is there.
That's Sheila.
Yeah, I don't know why people don't show their pictures. I paid extra to let everybody show their faces, and no one's showing their faces yet. We typically give people a few minutes.
Well, JT is on the Peloton, so he's probably not going to get off the Peloton.
Really?
Yeah.
Well, Bob's always here. He just needs to adjust his camera a little bit lower. Oh, he just took himself out.
There he is.
There's Bob. Okay.
Hey, Bob.
Hey, Bob. Let's see. Dave. There you go. Oh, all right. Dave is wearing Longhorn shirt. Okay. Dave, when you need a deal done, mention that you're wearing a Longhorn shirt on this program. We'll give you a special rate.
It's all about you, Dave.
I can be bribed. And James is looking at me saying, well, man, I could have worn a Longhorn shirt last week and you didn't say anything. Let's see, who else do we know on here? I see a lot of people we know. Apparently no one is wanting to show their face, which is unfortunate because they know I call all of them out.
Oh, I see.
I see Candy, Yossi. There's Ball. Ball, how you doing? Good. We haven't seen each other in a while. So in a minute, I'm going to tell you guys about a very interesting interaction I had with Facebook before we talk to our mistress of ceremonies. Mistress?
Oh, I guess
Mattress
that's
Giant.
Doesn't.
Yeah. Before we talk to Julie, the woman of the hour, I'm going to tell you guys something about a Facebook
situation
event that occurred this morning. Let me see how many people are on before I start. So there's some, my wife's saying she got it too. It's because we post the same type of stuff. Yeah, I still want to know the name of the woman who 2 podcasts ago, when I was just saying hello to everybody, her husband said, what are you doing? And excuse my French people. She said, I don't know. I'm waiting for Meryl to stop fucking around. And she said that on the Zoom call. I thought it was entertaining, but I could not catch who it was. So if you're that person, shoot me an email, and I better not have more than one email. Yeah, that's the type of crowd. So I'm gonna just go into it real quick while people get on. Cindy, will you watch the chat box in case people have questions of Julie as we go through and stop and then I'll introduce Julie's guest as well. So I have tried to remain very non-political since COVID started, and whether I thought, people were going overboard, not overboard, the media is off track, on track, everybody's got their own opinions. But I think I'm like everybody else where I'm kind of to the point where I don't know who to believe, what to believe, blah, blah, blah. I try to consider myself a sharp guy, and if I don't know it, I research it. You try researching what's true and what's not true about COVID. It's kind of a joke. So I posted 2 days ago. All I did was I reposted a CNBC, which I rarely ever look at. You can figure out which side I'm on. But I posted it, and they made that statement that, oh, the WHO has now said that, Yeah, that you really can't get COVID from an asymptomatic person. I didn't even have a comment. I reposted it, and I said basically, now what are we doing? Something like that. So I'm going to show you guys what I got from Facebook, which is very, in my opinion, very scary. I'm going to share my screen. And so I got this on my, can you guys see my screen?
Yes.
Okay. So I got this on my Facebook under my, you get a little notification button, and I'm nobody special. I mean, I've got 5,000 friends, but there are hundreds of thousands of people, I'm sure, with 5,000 friends. So I get this the very next morning, partly false information found in your post. I've been flagged for a fact check. And so I'm looking and I'm like, what is going on? So I've been essentially censored for improper facts. Keep in mind, I posted the CNBC report that broke and said, hey, people who do not show symptoms contribute to significant blah, 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 is contrary to CNBC report. This is kind of their response, their health feedback. So I posted the report, and then the next day, the WHO backed off and said, the woman misspoke, the doctor misspoke, blah, blah, blah. So I'm looking at this. I'm thinking, number one, at what point in time does Facebook decide what is or isn't accurate with respect to medical science on a pandemic in the world? I've already seen comments about people getting censored for stuff regarding the protests and the riots. And so, which I thought was, these people are just saying stuff. This is actually on my screen. So the next one, I'm like, me, I've got to look at this. And so apparently my scientific credibility of my post is a negative 1.5. I've never gotten a D in school, but I got a D on this post. And then, as you can see right here, they have two scientists that Facebook hires to go and search posts when they're flagged. And then the editor is some science editor, but one is a mathematician. The other is like assistant professor in epidemiology. They go through and write out an entire report on the article, 2 pages long. And then my article now is flagged. I thought it was a joke at first until I had 5 people that tried to share the article. They all got the same flag on the article. This is an article from CNBC, which presumably is on the left, which presumably matches up with what a lot of Facebook does. And so now we have, and I'm not a conspiracy theorist, blah, blah, blah. Now we have this kind of, Facebook now is deciding what we want to see and believe and what we don't. So it gets even better. So sometimes I can be a little excitable. Most of the people in my office know that. So I get that, and I'm like, WTH to my wife, and I'm like steaming that someone told me not to do something, big deal. So anyway, I prepared this post that I'm going to send out to 5,000 people plus our private group of 1,000 people saying, hey, isn't it ironic? Facebook did this. We happen to be launching our own private social media app that we've been working on for 9 months with a California company. And it's 45 days away, but this is exactly why we want to do it. And I said, Facebook did this, 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 this. So I laid it out, put screenshots, I posted it. Guess what? It never went anywhere. The post is gone, never showed up on my feed. This was this morning. I'm showing my wife, and it's just gone. So listen, I like Facebook as a way to communicate with everybody and get apparently some information out, but I'm just giving everybody a heads up. This happened to me this morning, and I don't know who else or what else gets censored, but it was very, very eerie. So you guys really don't give a crap what happens to me, but I'm just telling you, it was very interesting. So let's see if there's anybody else on that we need to acknowledge before you get going. Zulika's on again. Thank God. She left early last time and she's not showing her face. All these people that don't want to show their face, weren't you dropping rates by like 15 bips for people to show their face on?
Yeah, definitely.
Yeah. That's a shame. So all these people.
It is a shame. I'm really sad that we won't be able to do that.
Yeah. Oh, there we go. There we go. Zulika. Now I see her. Thank you. I miss our meeting. I need to have another happy hour in person when everybody feels up to it. So I'm going to give a little introduction about Julie. Let me just, there we go. I have Julie on the big screen. I'm gonna give an introduction about Julie. I think I met Julie probably almost a year ago. And I didn't actually meet her. I think I met you, the first time I met you was at the Old Capitol event here in Dallas.
That's right.
Julie lives a little west of Dallas, the country of California. And
The great state of California.
Right. I promised everybody that I would make 0 comments about California because we have lots of wonderful investors and clients there. But it's funny how nobody wants to buy property there. But she is from California. I actually had no idea. I thought she was in Dallas because I had so many interactions with her. Her state, the state of residence never came up. But Julie has sent us quite a few clients. As you guys may or may not know, I'm also, I use Old Capitol on our deals. They're one of our preferred go-to mortgage brokers. And their team, not only, you know, do they provide plenty of variety as far as the types of loans and how they help you, you know, initially figure out whether a deal works or not, which is great, but they actually will get them done. I think probably 75, 80% of our clients, we have quite a few clients, our syndicators, use Old Capitol, and it's amazing because we'll watch some of the deals and Cindy and Greg will probably nod their head where we think they're just not going to happen. And somehow Old Capitol gets it over the hill and boom, they close. So very impressive group. I'm fortunate enough to get Julie. Julie's awesome. Okay. She's funny. She's brilliant. She treats her clients and our clients unbelievably well. She has a good sense of humor because I give her a hard time a lot.
I like it.
Even asked her why she was doing a green screen. And she's like, oh, do you want me to take it down? I'm like, it's your show, Julie. I'm just giving you a hard time. But Julie actually has some very good information that she's going to be able to provide. And I know you guys have heard some of the lenders out there, some of the mortgage brokers talk about, you know, what's going on, but it seems to be mostly just fear and scaring everybody. And I'm a syndicator as well as a syndication lawyer, and we're out looking for deals. I'm looking for deals right now because I know brokers like mortgage brokers like Old Capitol actually can not only can find the financing, have financing lined up, and are with us step by step as far as making to see if the deals work. We are fortunate, though he's not part of the call. Julie brought a friend. It's like Phone a Friend, that game that, you know, it was Lifeline, right?
That's it.
Yeah. So anyway, so Julie's Lifeline, not a lifeline, but one of Julie's friends and lenders, Trevor Brotman, with a little tiny bank called Wells Fargo, is on the call too. So at the end, if you guys have questions, he's waving up in top of my corner. We're fortunate enough to have Trevor on. It's very hard to get a lender to jump on a little show like this. But I'm going to let Julie start her PowerPoint. I may interrupt her because I like to mess with her a little bit, but it's
because
also
that's the way you are. Because that's the
also
way you are, right?
Terms. And Julie really loves me in real life, so
I do. I'm very, very. I really like you. Now, can you see my screen?
No.
You cannot
Jeffrey?
see my screen. Okay. Here we go. Screen time. Now you can. Let's go to screen. How come that's not coming in?
It's on.
There we go.
There you go.
There we go. Well, thank you so much for the introduction. I have Trevor, as you said, riding shotgun. Thank you, Trevor, for joining us. It is true. It's not often that we can get lenders on the line with us, but he is a great lender. You've heard of Wells Fargo before, and we're happy to have him here. So thanks. And Cindy, we love Cindy. We always are pushing business over to you guys, so it's a great fit for us. And gosh, look at us. Show me the money, Meryl. Show me the money. I love that. You did a great job. I think it's Rob.
It was Rob.
Right? Let's give it to Rob. All right. So anyway, everybody, thank you so much for joining me tonight. My name is Julianne Peterson. I am a commercial loan officer for Old Capitol, and I do reside in the great state of California. said nobody, right? So yeah, we are based in Dallas, Texas, and I'm here to tell you that there are deals and there are things going on outside of the great state of Texas. You know, we've got 6 offices, and 5 of the offices are in Texas. So I'm in San Diego. It's about 100 degrees here. We have no air conditioning just because, oh, we never get higher than 70. So I'm sweating over here. But let's go ahead and think about what it is that I bring to the table. I've been in real estate transactions for 30 years. I purchased my first property when I was 22, again in the great state of California. And I now own properties here in San Diego. I own and manage them. And I'm also a passive investor in the great state of Texas, in Kentucky, and in North Carolina. As a commercial loan officer, we've got lots and lots of options for lending, but I really do specialize in multifamily. And you know, we have about 85% of our business at Old Capital is done in multifamily, but we will do other areas like industrial, office, retail, storage, and mobile homes. But we really do specialize in multifamily.
Julie,
Yes.
do you guys do 50-foot boats?
The one that's for sale? No, I just drive those. I just drive around on those.
Okay.
Yeah.
What about
sorry,
Wells Fargo?
Can't help you. I'm still waiting for a ride on that, but.
So I think I need to get Trevor out here because he gave me a thumbs up. So I'll get Trevor out here.
Oh, okay. Trevor does, but not me. I'm sorry.
Go ahead. Sorry.
Yeah, there you go. So I'm also an advisor on a couple education programs. I run a Zoom call on Tuesdays. I'm also an owner of a meetup here in San Diego called the National Apartment Investing Community, which is great. And well, we're shut down right now because of COVID. And you know, my friends, my colleagues become good friends of mine. Why? Because we like to do business with people we know, like, and trust, right? And then, so finally, I am a wife of 24 years. Isn't that the same as you, Meryl? 24 years?
Yeah, I'm a wife of 23
wife
years.
Of 23 years, okay.
Yeah, my wife's in the room laughing. She's agreeing.
Oh, she is? Oh, hi. Hi, Mrs. Merrill.
Yeah, Mrs. Merrill.
And and I do have 4 kids, so that's just a part-time job, if you will. All right, just so you know, a lot of people think that we need to have the LOI and we have to have a signed PSA to call me. Call me before you put in the LOI. I thought this was kind of an interesting little tidbit. It's call me before and then your PSA, and this we can take you through getting to the end of the deal. So that's just kind of showing you the application. Now, if we're talking about Freddie, we can set the loan when you lock the loan when we sign, or on Fannie, it's a process. So we don't get into the approval and then it locks at the term sheet. So.
Hey, Julie, can I comment on that, since that's actually a really good point that a lot of people don't understand. So when I'm looking at a deal, way before I even do an LOI, most of the time I contact Old Capital, and we all have our pro forma that we write up, and even just literally it's like a back of the napkin pro forma, and I run it by them because 90% of the time, especially now, what's going to make or break the deal, aside from good property management, is how my lending is going to look. And especially now where different lenders have different requirements and the rates are constantly changing, the calculations are changing. It's kind of like we do with the law firm. We tell everybody, send us a draft of your LOI. We'll go ahead and mark it up so it works. I don't want to talk to you after PSA. I mean, we'll obviously represent you, but we want to make sure from the very, very beginning that you're doing the right thing. And I absolutely agree with Julie, because Old Capital has saved us from getting into 3 bad deals that I thought Fannie was going to come in higher at, and they came at a much lower after talking to them. They had some information I didn't know. And on top of that, a little secret. I guess it's not too much of a secret with 100 people on, but sometimes Julie and other people at Old Capital are sent kind of pocket listing deals, because I get them every once in a while from Old Capital that says, hey, this deal's about to go on the market. We've already just preliminarily sized the deal based on what they want to sell it for. You might want to call them up. And that's truly a value add. It doesn't happen that often, but it seems to happen at the time I'm looking for it, which is really interesting. But they do come across some very interesting opportunities. So it never hurts to send some tips treats to your favorite mortgage broker or something else to get on the top of their list. Yeah, iPad, yeah. But that's not why, anyway.
Oh, yeah.
Okay. But very important, guys, what Julie said about contacting her first, absolutely. That's almost as important as the price you're buying it at, quite honestly. Sorry, Julie.
No, really good point. And to that point, you know, a lot of times I'm working with newer investors who don't have deal sponsors. So I have a list of deal sponsors. So if you are a deal sponsor looking to help others, again, this is about teamwork, as you know, that come to me, let me know, hey, I will help others out. That's really helpful for me. And then you can, I mean, basically I'm helping you get into a deal where you might only have to put a couple bucks in and sit on their deal and help educate them and maybe put a little more pennies in your pocket too. So keep in touch with us. We are your biggest partner in this deal. So I wanted to take you through today's agenda. I don't think we're probably going to stay on it because we have a tendency to veer off in other directions, but I want to talk to you about loans that are available, not only in COVID, but before COVID, what that's looking like today, how you can qualify for non-recourse financing, because I get phone calls a lot saying, hey, I got $15,000. I got a $4 million deal and I want to close it. Can I do that? There's also been some reserve requirements with the COVID situation, so I want to go over that. And we're going to actually not get to forbearance. So we're going to not talk about that. Although, you know what? We can have Trevor talk about it because we'll give him something to share on here. So
thank you, Trevor.
That it is good. So at Old Capital, there are other lenders out there, other brokers like ourselves. We have 5 different types of loans that we see. We carry probably 4 of the 5. First is non-recourse, as you see here, or let's go to the first one. It's recourse. That's your bank or your credit union. That is basically the bank that says, hey, give me your wallet and I'm going to put it in my pocket. And after you pay me, you can have your wallet back. They really hijack your balance sheet. So in syndication world, that's not necessarily a great option. So number 2 is a non-recourse loan. And this model came in about, I don't know, 5, 6, 7 years ago, the syndication model where, you know, back in the day, there was only a couple rich people buying apartments that had lots of capital. Maybe they got it doing gas and oil and gas. And the syndication model came and it opened up doors for people like you and I who had $50,000, $100,000 and were able to have a piece of an apartment. So non-recourse really is a great option for the multifamily asset class as well as other asset classes, but it's really something kind of special to this asset class. Then you go to bridge loans, and bridge loans became very popular 2 or 3 years ago, where Fannie Mae, who needs it to be occupied 90% is considered stabilized asset. These were becoming more difficult. Maybe they were 75%. People were looking to reposition from a C to a B. And so we started to see a lot of bridge loans. Now, we became a little bit concerned about it because a lot of new people were coming into it. They were getting loans and we didn't know what was going to happen. We didn't know that COVID was going to show up, right? So we may be seeing some opportunities of folks that are in bridge loans right now that are scrambling.
Can I,
Our
can I, can I
Yeah,
comment on that?
sure.
I'd love to just get you off topic.
Perfect. I'm good.
Just giving you a chance to breathe. So bridge loans, Julie is dead on. As a law firm that's represented quite a few over the last, I would say 4 years, 3 years, 4 years. One thing we have found out from clients, I would say several, there are a significant minority of clients that chose to do bridge loans, a little higher leverage. As Julie said, they would be a little more, they would take on more risk, but they were typically structured as 3-1-1s. So you had a locked rate locked rate for 3 years, and then subject to the lender's approval, you could get an additional 1-year extension for 2 more years. So everybody that we have talked to since has said basically that none of the bridge lenders are doing any extensions. So now this goes back to opportunity. That's all I'm getting at, is there is opportunity. We have clients right now that are scrambling to find financing, and we'll hear from Julie in a little bit about what the loan to value is that lenders are looking at, the range. But a lot of these bridge lenders, these bridge borrowers, I should say, borrowers that took bridge money, were borrowing at 75, 80% plus 100% of capital improvements. And so, they may not have property managed or asset managed the way they should have. I'm not saying they did or didn't, but they may not have. And then you factor in COVID when the loan is due, so they don't have the economic occupancy that justifies getting a Freddie, a Fannie, a Wells Fargo, or one of the other loans. They could get one, but they're going to come to the table with quite a bit of money. So what happens now is there's opportunity. There's opportunity to take over the notes. There's lots of opportunities. Those are happening today. If people are telling you there are no opportunities today, those are actually happening today. We have threats of foreclosure by several bridge lenders already. They are not, I used to be a hard money lender a long time ago. Julie would have been, she's shaking her head. Julie, these are then the 14% and 4-point days. Kind of like what Wells Fargo charges right now. I'm kidding, Trevor. Totally kidding. But yeah, we used to charge 14% and 4 points on 6-month commercial loans. I mean, life was grand. But because we were a hard money lender, we never loaned on anything we would hesitate to take back, and we took them back. Great state of Texas, you get it back in essentially 30 days, plus or minus. So anyway, great opportunities. Look for people with bridge loans trying to exit right now. I'm done.
Yeah. We're in a position right now where we're trying to refinance a property. Oh my gosh, won't go into too much detail, but they purchased the property. Actually, they were in the process of purchasing a property 6 days before they were to close. Hurricane came. Then the owners rehabbed it. They closed on a bridge loan. It wasn't a Fannie, it was Freddie. It was a bridge loan, and it's only like a 2-year bridge loan. And now COVID, they had to redo everybody else. The previous owner had to redo all of his crap. They took on bad tenants to fill up the properties. The new owner comes in, has to redo the old stuff, has to get rid of the old tenants a year later. Now COVID hits. I mean, we're struggling to get, we're trying to get collections. What does that look like? And, we'll hear from Trevor in just a second, because this is what our challenge is, to find out what do the delinquencies look like? How long is this going to go on, right? I mean,
looks like, Julie, it looks like opportunity to me.
Definitely opportunity for, well, in this case, it's just going to be hard to find him a loan. He needs to get out. He wants to keep it. He doesn't want to sell it. So we're just trying to find an option for him. But anyway,
good for you guys.
CMBS is another opportunity for multifamily. It's extremely expensive, $50,000 for an application. They're closed right now, so we're not going to spend too much time. But this is, something that's out there. And then as well, the private loans. We do not do the private lending from Old Capital, but you can call up Merrill and maybe he'll make you a deal. All right, so let's quickly go through this wonderful map here of comparison. And Mr. James Ang, who's, you know, the professor, helped me out with this. And it's a great graph to show you, or a breakdown. If you look at the loan, a bank loan, so it is not, it's not non-recourse, so it's recourse. So there's not a lot of flexibility. The loan amount, there's no maximum or minimum. And as if you look, there goes Paul Peebles is entering the room right now. Recourse is going to be Fannie and Freddie, and we do bridge loans that are non-recourse and recourse. We're of course going to be going towards non-recourse. The occupancy, as I mentioned earlier, 90% on a physical occupancy is what we consider for Fannie and Freddie. We will look at stuff that's at 85% economic, but we're looking for 90% physical.
So, Julie,
yes.
This is something that I also hear from Trevor as well, is the different lenders are looking at now between economic and physical, because pre-COVID, I don't think we had nearly the discrepancy on, we'll call them stabilized assets, because a lot of stabilized assets have become semi-destabilized on the economic ring, but their physical occupancy is still 90-95%. And quite honestly, if it's a Fannie or Freddie loan, it's going to be stuck at that regardless of whether they're paying, at least through August, maybe September. But like it says, flexibility for bank loans. I don't want to put Trevor on the spot, but he happens to be a bank. Are they looking more at Jeff unmuted you, Trevor? Are they looking more at economic or physical, or is it just a depends?
Yeah, it's mostly economic at this point. You know, we're going to look at the trends and see what sort of percentage decline there might be, specifically with Fannie Mae loans, because there is a mechanism to underwrite something that is more conservative. Really the lowest of a T1, T3, T6, or T12, and maybe discount that a little bit as well, up to about 2%, depending on the behavior at the property. What's interesting is that we're not, and I think most folks would tell you right now, that we haven't seen a dramatic decline. I think market-wide, and we look at deals nationwide out of my shop. So we're not seeing as big of a decline, although it's anyone's guess what's going to happen when stimulus dries up a little bit or goes the other direction. So I think we're prepared for it. We're surprised that we're not seeing as much of it, but the folks at Freddie Mac, our partners there, and then Fannie Mae as well, they expect us to be prudent. And I think that what that's going to translate into is really the lowest of T1, T3 at this point.
Yeah. So one of the key things to keep in mind when we're doing, thank you, Trevor, by the way, Freddie and Fannie, we're going to be looking for net worth and liquidity. That is key. The $15,000 for the $4 million loan, not going to happen. All right. We need somebody to be bolted on that has net worth. Now that can come from one person. You've got a lot of high net worth individuals. That's great. If you can get one person, you know, that's optimal, because every time you bolt somebody on, you're taking money out of your pocket in the syndication model, right? So you got to have it on the net worth. It has to be greater than the loan amount. So if it's a $4 million loan, you got to have net worth of $4 million. Now that's typically across the board. You're seeing that. Sometimes banks will be a little bit more flexible on that. The other item that is real important in multifamily in the agency is the liquidity. And by that I mean cash or marketable securities, not anything IRA, nothing that is, you know, you can't get to. Has to be in your bank account. So 10% of post-closing liquidity. So that is in your bank, 10% of the loan amount. So $2 million, I need 200,000 of liquidity. On Freddie, you're talking about 9 months debt service, $9,000 a month debt service times 9 months, that's 81,000. I need 81,000 in your bank. Now, maybe one person takes care of your net worth and liquidity. Hopefully that's the case. Maybe it is a deal sponsor that's going to help you get the deal done, and they're bringing the experience, the net worth, and the liquidity. That's a perfect fit. That's who you want to look for, okay? When we're talking about max LTVs, these have kind of adjusted with COVID, and I'm going to push it over and get some advice or what you're seeing, Trevor. But, you know, where we saw our tertiary markets, maybe we're at 65, 70, maybe they've gone down to 65, maybe they were at 70 one time, now they're at 65. 80 has really come down 5 points to 75. You know, so if you were used to seeing 80, we may not be able to get there right now with COVID. Can you elaborate on that, Trevor?
Yeah, I would echo that. It's not that we won't do 80%. It's just to have interest only and an 80% loan with a good price. You're not going to get all three. It's highly unlikely. And I would say most of the deals are still tough to get to 80% anyway. We haven't seen discounts in pricing more than about 5% unless it's a distressed situation. So I don't think we're in the neighborhood yet where cap rates have adjusted to a point where the 80% LTV is going to be more predominant. But 75 is always a good target. And then also depending on the markets you're getting into, if interest only is important for your investment, which it generally is, and I think anyone who did an interest only loan last year is loving life because they can withstand, you know, the uptick in delinquencies if they have any. There's a lot of cushion there. I recommend it. My credit people aren't wild when I say that, but it is one of those things I think that is important to help transition an asset in good times and bad times. When you buy something, you want to have a little cushion to get through it. But so I would say we're not quite there yet where we're seeing higher cap rates translate into higher LTVs. And of course, there are markets that are really maybe struggling. We're having a hard time in Orlando. We're having a hard time in Vegas, as anyone can imagine. Most of the middle markets are doing okay, but there are some areas where we're not likely to be pushing leverage. Either tertiary markets, that's oil oriented. We've kind of run into that again, just because of the behavior out there in the marketplace.
True. Yeah, so when we look at the bridge loans, if you compare them to Fannie and Freddie, as Meryl had said earlier, you're looking at 3-year interest only, or you've got the additional 1 and then an additional 2. Okay, so that's how that works. When you go to bank financing, you're looking at only 3 to 5 years, which, you know, that's not optimal. And so the Fannie and Freddie in this asset class works brilliantly. So one of the things I will tell you about the Freddie versus a Fannie, and it's kind of something you should take it into consideration. If you have a rehab component of the deal, whether it's, if we're talking about small balance Freddie, you are not going to be able to roll in the rehab on a Freddie. On the Fannie, you can. And that works out great. We can add it to the loan amount. Of course, we're going to need to make sure that we have an experienced operator on your team as well. Now, the other thing that I really love and I want to point out is the supplemental loan on the Freddie. It's fabulous because it gives you an opportunity if you want to hold a legacy asset. You want to hold it for 10 years, let's say. You've got investors that you're committing your business plan to 5 years. At year 5, you could bolt on a supplemental and you can say, hey guys, thanks so much. Cheers. Here's your money. Take a hike. See you on the next deal. And then you take that coterminous to the end. It's a great strategy. And Fannie's the guys that do it. Now, Freddie, it is available on the larger conventional loans, but I think it's kind of special for the Fannie small balance. And it's worth having you know about that. Another thing that I want to point out to you is that on bank lending, you usually only have your amortization 20 to 25 years, where with these Fannie and Freddie, we're looking at 30 years amortization. So that's a real positive thing for these types of loans. Borrower, yeah.
What's a small balance loan for those that may not know?
So yeah, and we're going to come up with that, but for right now, it's $6 million and below. for Fannie and Freddie. Now we will see larger on some Freddie deals, but for the most part, we're looking at 6 million and below, or 6 million and above. Okay, and we are seeing, and I've got a here it says the minimum loan amount. If you look at Fannie, yeah, we'll go to 750, but do we want to? And does it make sense? Not really, because you're going to pay for your third-party providers to do all of their surveys and engineering at 750, as well as 10 million. So it's going to cost you a heck of a lot more to go with 750 and pay all that than it does at 10 million. So something to consider. Now, maybe you're in a group where you do need recourse, and so we're going to visit with you on that, but it is an option. Okay, and then the last thing, the borrower experience, I talked a little bit about it, but we really want to see somebody that has experience in Fannie and Freddie. Now, that's what I'm asking for. I'm hoping to put people that have the experience with people that I am doing business with that don't have experience, to help them, walk them along. So the experience is, maybe it's single family and a couple duplexes and this and that, and maybe we can get you on a Freddie loan if you're local or you have a third-party property manager. But for the most part, if we can find somebody that's a deal sponsor to help you in your first, second, maybe third, depending on it, that's what we're looking for. So when you're building your team, that's who you're looking for, your deal sponsor. Are there
Julie,
any questions on that?
Do you guys help at all? I mean, if you know somebody, are you guys helping, or are you just telling people go out and find? Are you like Match.com for syndication lending?
I would say I am, yes, I am the swipe right. No, it's swipe right.
I don't even know what it is.
Yes, I know, that's right.
Thank God.
Yeah, it's good. You shouldn't know.
Yes.
Anyway, that's it. I mean, that, yes, we do help with that. Some more than others. So it just depends on, you know, where we're at in the cycle. So I'm
That's
certainly
awesome.
looking to help people make contacts and put people together. So, all right. So here's the deal. We're talking about what it is today. So bank lending, it was shut down. Why? Because Granny came in there and said, oop, I'm taking my money. And so there wasn't a lot of money in the coffers. All right. So they're like, hey, the stocks, I got to take my money. I got to put it under my mattress. And so, and also at the same time, you know, we started to see this SBA, the PPP and EIDL, and that took up a lot of focus for these regional banks and local banks and credit unions. So now they're open. Now, to what extent, you know, it just depends where you are, how big they are, what they're looking for. But they really want to know, when you're bringing them opportunities, what is the tenant base? Is it a bunch of people that are, you know, hospitality? Are we looking in Las Vegas? Because that's going to be a problem. Is it oil and gas? East Texas. There's almost in a deal out there. That's going to affect the tenant base. So we're going to want to know that. And not real much changes from what it was before in banking. Now, 3 to 5 years is standard. What you'll see, 70 to 75%. I have heard just recently that the banks will be going to 30 years of amortization. Now, that's not across the board, but I did have one call me today and said that he would do 30. And then there's also this question when we talk about liquidity, where you have a deal sponsor that's helping you with this deal, and he's on 8 different deals, and he's bringing his $400,000 for liquidity. And what happens when he goes into forbearance on that one and that one and that one? So I think we're going to start to look at, like, how much leverage is the person that's bringing the liquidity in? That's not happening currently, but I think there's going to be some consideration. I'm going to push it over to Trevor. Am I stating it correctly? Would you agree? What's your thought on that?
I would agree. I mean, I think the forbearance aspect of things, I mean, that's going to be part of the landscape. It's not as prevalent as we expected, and we're happy about that. I think, though, you really need to have a hardship. And so to the extent that you do have a sponsor that it seems to show a pattern, well, then we're going to pay closer attention to that. But to have forbearance doesn't necessarily preclude folks from making loans. But if, again, it becomes a pattern, we're going to be much more careful with our decision making.
Yeah, I think it was a little more flexible maybe in the past, potentially. Okay, so Fannie and Freddie are still open for business. You know, when this whole thing went down and people were losing their jobs, the interest rates went up sky high. We were able to put in some spreads that were protecting, because remember what happened in 2008 with the crisis, the recession, the Great Recession. We didn't have stopgaps in place. And now we have learned from that, and let's really face it. This is not a downturn that we were looking for or looking at or expecting. This is a health crisis that now has changed kind of the landscape and some of the concern, right? So we're going to be really looking for somebody that has experience, that has the wherewithal, has some take it from start to finish. We want to understand that. And I want you to all understand that when we are looking at Fannie and Freddie loans, we're looking for backwards. We're looking backwards. We're looking at the T1, 3, 6, and 12. We want to see how this performed. How is it that we're going to be paying this amount for this property? It's about performance of the asset. So when we are thinking, well, I'm going to do all these things in the future, I'm going to say, yeah, that's great and wonderful, but I have to look behind. I have to see how it was being run. Again, we're going to need net worth and liquidity, the post-closing liquidity, same thing we talked about before. We're going to try and understand the economic vacancy, as we talked about earlier. And then we did see rate locks. Originally, what we had seen is you could do it at the time of signing. And with COVID, they pulled that out. We're not going to rate lock. And just recently, they're now seeing rate locks. There's going to cost you this time 2 to 5%. Is there anything you want to add on that, Trevor, on Fannie and Freddie?
Well, only that, most deals are going to happen. And I think Meryl, you mentioned you're looking at 75, 90 days. We're moving a lot quicker now because the rate locks are not early the way they used to be. We're moving a lot quicker to get to a commitment. So 45 to 60 days is I would say, normal turnaround for a Fannie or Freddie deal. Freddie Mac has opened the door for the index lock, which went away for a couple of months, but they are back doing those. It does cost, obviously, 5 basis points, but when you figure Treasuries moved 20, that 5 basis points was worth it. So I think we'll see Fannie Mae move back to that early rate lock, but for the time being, we have a little bit of a pause there. So we need to finish due diligence before we get in a position to lock a Fannie loan. I think the good news there is Treasury floors are still in play, and Fannie Mae on a 10-year loan is going to have a 90 basis point Treasury floor. So there's a little cushion in that when you quote spreads over a Treasury floor, but that doesn't mean they can't run up on you. So the key is getting in early, often, as quick as you can with your due diligence. And obviously, if you're in an acquisition mode, just to be careful that you've completed enough to make yourself comfortable, and your guidance from your attorneys as to whether you're at risk.
Hey, Trevor, I'm just curious. So in a market like Dallas, and let's assume Houston hasn't been affected by the perceived oil and gas issues, what kind of rates are you guys seeing right now on a typical, late 70s, early 80s C class that's got pretty stabilized occupancy? What kind of rates are you guys seeing?
Right. So if it's a full loan, let's call it 75, 80% with debt service coverage at 125. So you're pushing proceeds. The key right now is whether or not it is what they call mission oriented. So the agencies both are obligated to do 37.5% of their business what they call mission space. And that is typically 60% affordable units, and not necessarily deed restricted, but those count. But units that are affordable to folks making 60% of area median income or less. What's interesting about Texas was that was predominantly an 80% of AMI market, which it still is. So the agencies like workforce housing, they'll price better for it. But if you can get mission done, then they'll price much more aggressively. So something that is, let's call it older in nature, typically wouldn't have high rents. They generally are naturally occurring affordable. So, so to answer your question, if it has mission-oriented rents, then we're probably looking at somewhere closer to 3% on a 10-year loan. And if it isn't affordable, it's probably closer to 3.25% for an all-in rate. So, and I would say the agencies are a little different in that Freddie Mac has higher spreads, but they use a lower treasury floor, so they kind of go around their elbow to get to their thumb there. And so they are still competitive with respect to all-in rates. It's just a function of how long before you can get that rate locked. So you have to determine your risk based on that. But generally speaking, 3 to 3.25% for a full loan.
Have you seen any sub 3 yet?
Oh yeah. Well, we have certainly on lower leverage. And I've been doing this agency business this is my 21st year, working with the same platform. And I can safely say that the lowest rate I ever locked up before the pandemic here was somewhere in the neighborhood of, I think, a 283. And we did a handful of mobile home parks, which are considered 100% mission. So if you're into mobile home parks, they're great investments, I think. And we'll do them all day long. They were lower leverage. We went off at 265 last week.
Wow.
Yeah, I need to go buy some mobile home parks.
Yeah. Hard to find.
Yeah, I know. They're mobile.
There you go. Okay, so we're going to just close this up on Bridge, just so you know what's going on. These two have been closed, but I'm getting small indications. I've got some that are coming online that have been doing it the whole time, but the majority of them are starting to, show their face. So we're excited about that with opportunities coming up, right? So when I talk about Fannie and Freddie, I told you we look backwards. With Bridge, we look forward. How is it that we're going to move this asset from $600 a door, cost a monthly rent, to $1,000 a door? So we need to know what your rehab is. A lot of times these are best if they're $5,000 a door. That's where we like to see they start. I need to know from you, what are the rent bumps? How are you going to achieve this? You're going to need to tell me what the competition is. Who around the corner is charging $1,000, and what have they done? So I have to hear the whole business plan. How are you going to achieve this? A lot different than when we talk about Fannie and Freddie. So you need to be aware of that. Also, we're looking for property managers who have done this type of rehab, or get a person on your team that's a construction manager, somebody that knows how to do it. This is not an option that is for people that are inexperienced. You need to know what you're doing. Now, if you've done 400 single family, we probably can have a conversation. But if you're just new to multifamily and you got a great idea, you got the $15,000 and you're going to be moving into a rehab, you're going to need to get some real help, some real sponsors to help you coordinate that. And again, these lenders we're going to see more of them coming up probably in August, September. So I wanted to make sure that I communicated really clearly, because I do get I work with a lot of young investors, and they don't know exactly what it takes to get non-recourse financing. So I want to make sure that if you are looking for people to be on your team, Find people that can fulfill these different circles. Maybe you've got one, like I say, that can get you the net worth, the liquidity, and the experience. Maybe you need somebody to help you raise the money. Make sure, right, Meryl? Make sure that they're doing something in the project. And then make sure that all of this is done, and then, I'm going the wrong way, then you can get to looking at the properties. Don't do it backwards. I get a lot of phone calls. Oh, I found this deal. Well, where is it? Oh, it's in southern Florida. Okay, where do you live? I live in Iowa. Okay, how are you going to manage it? I don't know. I'll find a property manager. Okay, how much money do you have? I got the 15,000. Do you have any experience? No, I don't. So we're trying to find all the people to fill those pockets. Set your team first, then find the property. Know where you're going. What market is it that you're going after? No, am I going after C's? Am I going after B's? What is the plan? And stay focused on that plan. So we do have reserves right now. These are required. Trevor, how long are they going to be required for? Not putting you in the hot seat, but
Pressure, Trevor, pressure.
Well, look, I mean, 2 months ago, we thought they'd be there, solid for a good year. Of course, we've seen things lighten up a little bit. I fortunately have a bit of insight because I sit on Fannie Mae's originator subcommittee. So we have 8 to 10 other representatives in the DUS community. And the first call we had about the reserves, of course, was lively. And I think the message that we sent was at least make the reserves consistent with the transaction. And so if you're doing a deal that's lower leverage, maybe don't require them. If you're doing a deal that has interest only, maybe don't require principal, right? If we can waive reserves for taxes, insurance, replacement reserves ongoing, and that typically doesn't happen unless you're lower leverage and have some coverage, but why take them up front if it's not part of the transaction? So they heard us. They have been loosening that up. I think if you have select sponsors or large priority borrowers, they're loosening that up. Seems like every week there's another little nugget there. So I think at some point we're all gonna pay closer attention to who we're waiving those things for, what type of deals we're waiving them for. I can say that we haven't seen a lot of latitude on smaller loans. So something that's under $3 million in Fannie space, they really just don't want to give any exceptions. So, so I think that'll be the last book of business that really gets, becomes a little bit more lenient on the reserves. I do think that they're going to be in the market for probably the rest of the year, if not another year completely. And I know nobody really wants to hear that, but there are two things at play there. The first is, of course, no one can predict what's going to happen with collections. So that reserve does get applied. Freddie's program's a little bit different. I think it's important because they use a collection threshold. So if you break below that collection threshold, then the servicer automatically applies that reserve. Fannie's a little bit more nebulous, where they say, hey, what's NOI? That involves a servicer, so you really need to be careful what type of information you present in order to get that application of those reserves. But I think we'll go down that road. We'll apply these reserves. I don't think that they will go away, but they will be released if it's, and I believe Fannie Mae just changed their attitude on that today. Used to be it was 6 months and then 2 successive quarters to release that. Today they announced it would be 6 months plus 1 quarter. Okay, so we see them moving in that direction where things are loosening up a little bit, but I do think they're going to be prevalent. And not only that, the reason that your rates are staying so low is because the investors who buy this paper, so with Fannie Mae, it's a single MBS bond. With Freddie Mac, it's a securitization. The investors, the secondary market, appreciates those reserves. And so that's why they're keeping their spreads low, because they know there's a little protection there. So twofold, it's because we don't know, but it's also because the market's pushing for those reserves in order to keep their spreads tight.
Hey, Trevor, so I got a kind of a trick math question. It's not really a trick math question, but I'm trying to get some confirmation on this. I did hear that if I want to go buy a loan from, if I want to go buy a property from Julie, and let's say it's a Fannie property, I can assume that Fannie loan without having to pay the reserves. However, if that Fannie loan is now, let's call it a 60% loan to value, I want to put a supplement on top of it. Is it true that Fannie now requires reserves to cover the supplement and the original assumption?
That is correct.
So I could be putting a lot of reserves just to try to, so then then people like Julie will have to run the numbers for us to see if it actually makes sense to put a supplement today, or maybe it makes sense to just raise a little more capital and then put a supplement once those restrictions are put down. But
Right.
I just wanted to clarify, the assumption of an existing loan doesn't trigger the reserves by itself.
That is correct. A straight assumption, as long as the property is performing, would not have anything additional. I can tell you from experience, I mean, the supplementals that we've looked at in conjunction with a purchase, and they were ongoing in several different markets, but the vast majority of that supplemental was going toward reserves. So you just got to run the numbers, right? You're going to pay neg arb on it. So if you're going to pay that interest rate, and usually supplementals are a little bit more expensive than your first mortgages. So of course, with rates where they are, it's not so bad to have that second mortgage money. But if it's all going to wind up in reserve, if your partnership was designed that way, which a lot are, and I respect that, it's just that you won't control that money until you meet the test.
Thank you.
Good question. So I just wanted to, again, I got this from the great James Zhang, put this together to show us 6 million and less. This is on Fannie. You can see 6 million and less is asking for 18 months on a tier 2. Now these were at 1.2 debt service. Now it's 1.25. So we've raised that up. 18 months debt, principal and interest, 12 months taxes and insurance, and $300 a door for replacement reserves. If you decide to bring in a little extra money, it's going to drop down to 6 months. We've got the taxes and insurance and the replacement reserves. You can see after 2 consecutive quarters, we'll look to release that to you. And then if you go to the conventional, it goes from the 18 to the 12 months, depending on, if you're at 6 million or more, you're at, again, 1.25 and 12 months reserves, 6 months at the 65%, 6 months reserves, and then no reserves for the 55%. Now, that really doesn't make sense when it comes to how we look at multifamily and the way that we, the benefits of it by going into that low leverage. But, maybe if it's something where you're looking for a legacy asset, maybe that makes sense. Or maybe you got 1031 money, that makes sense. Here is the breakdown on Freddie. On the top, it's the SBL. You can see at 12 months, principal and interest as opposed to 18 months. Okay, and then those are released either 90 days after the declarations or 12 months. Okay, and you have to have at least 80% occupancy, and you have to make sure that the T3s, the collections are greater than what they were originally quoted. And then the large, very similar, but they don't have the 12 months on the release date. And you can see here that drops down depending on the DSCR. You've got 140 is at 9, and you got greater than that is 6 months. So just something to think about if that makes sense for your transaction. We're seeing a lot of folks taking their foot off the gas right now. And as you might have tuned into the webinar that we put on, we asked for very experienced operators who've been doing this as long as 37 years. And we asked them, hey, if you looked at a deal in Dallas, 200 unit deal in Dallas, how would you finance that? and every one of them said bank loan. Well, why is that? It's because of the reserves. They just are not, you're not able to get the returns that you want. Now, maybe you have the conversation, and I do recommend that you are surveying your investors to say, hey, we're going to come in low because of the situation, but we see that in 3 years, we're going to be able to turn this, you know, we're going to see income, we're going to see, maybe we're going to do the rehab with some of those reserves, but our cash on cash return climbs quite a bit in that 3rd year. So it just depends on your business plan. So should you buy now? Is this a right idea? The rates are really low. I mean, look at Trevor's doing a 3 below. I mean, it's crazy, but does it make sense? There are opportunities out there. We are doing quite a bit of refinancing. Acquisitions can and are getting done. We have showed that Old Capital is closing loans right now. And then the assumption is also an opportunity that maybe makes sense for you. If the deal was, you know, over the last 18 months, the rates weren't that far off. They may have been in, you know, 4.5, then maybe it makes sense. And maybe what we're going to see is if it gets bad enough, the seller is going to be willing to pay the yield maintenance penalty and get out, you know, so it's going to be an interesting ride. But really know your market. Where are you going to go? Again, there's life outside of Texas. There's a lot going on South and North Carolina, Florida, Georgia, Birmingham, Alabama, all good markets. So can you raise the capital? As I mentioned before, talk to your investors. This is the time. You know, maybe stocks aren't doing so bad today, but are you willing to risk a lot of capital that you have? Or do you want to have a hard asset? And maybe it's not the 10% cash on cash return. Maybe it's only 5 for right now. But you know, the tax benefits that come with multifamily makes sense. Okay. So, and then also just learning to know what's going on. We just don't know what's going to happen in August, September, October. Are the unemployment benefits, are they going to extend them? Right now, we're thinking they're over in July. We don't know, right? So it's all up, the balls are in the air. What's going to happen? So we're all anticipating some change. And so sometimes we talk about what books have we read? How do we bring knowledge to this and into this the unity of trying to get these deals done. So here is my words of wisdom, okay? Do business with the people you know, like, and trust. Okay, that might be a little old, but I do like it, okay? And time kills all deals. I mean, I got people that take months to do these things. And if you can get all your people in place and get into the LOI quickly, it may make more sense than waiting around, waiting for someone else. And remember that we as a lender are your biggest partner in the deal. So we're bringing 75 to 80% of the loan amount. So get together, let's meet each other, let's talk about your deal, let's learn what your goals are, let's get you set up so that when it's ready to fight, when the deals are coming down the pipe, that you are ready. And then the last thing, of course, is that you gotta be nice to Merrill. I mean, you just have to. So I'm just going to share a little bit about Old Capital. Do I still have some time?
Yeah, but I was just gonna go back to not to be nice to Merrill, because you just need to be nice to Cindy.
Let's go back.
Before we get that.
Cindy is just so nice. She's just so nice. We expect her to be nice. You know, we got to kind of massage you. That didn't sound very good.
Yeah, I know. I'm just going to ignore that. One of the things that you talk about is basically, you know, don't wait and wait and wait and wait. So it's interesting. Cindy and Greg and I have seen quite a few, and I mean, not a few, but quite a bunch of activity lately coming to us. So people are already starting to put together blind funds. And I hate the word blind fund. It just means the asset hasn't been picked. But they're already coming to us and structuring PPMs and company agreements, which can be modified to add an additional partner or two, they already know the parameters they're looking for. They are trying to be prepared to pounce on some of these properties that have very short fuses on them, going after that property that's a bridge loan that's distressed, or, you know, someone's called Julie and said, hey, look, you know, I'm having some real problems here and I just want to get out. And I don't even want to pay a broker's fee to get out. I'm not apologize to any brokers who may be on here, but, you know, Julie may come to you with an opportunity, and from the legal side, I think lenders and lawyers are your biggest partners. I just have to add that. But from the, it's not that easy to structure. Thank you. A well thought out, complex PPM and 506B or 506C. So I'm just telling a lot of people out there, there are people that are going after deals right now, but you really want to be proactive. And I think that's what Julia is saying too. You want to be proactive rather than reactive. I like the fact that people are putting together blind funds. They're not true blind funds. They're single purpose entities that are targeting kind of what Trevor said. They're either going to target workforce housing in markets that have very good demographics and very strong employment, or they're targeting other assets. If it fits in the box, it's a widget. If the widget generates the right NOI, you're good to go. But no lollygagging in an economy like we're doing right now. If you want to lollygag, just don't get in. And I know I'm telling people don't get in, and Julie's telling people to get in. But if you're wishy-washy, you're going to lose money, and you're going to lose the faith of your potential investors or your funnel of investors. If you say, yeah, I want to get in, that I don't want to get in, be prepared, talk to your lender, talk to your lawyer before you even have the deal, and go ahead and pre-structure. Now you can get to that old looking guy who was on the next page.
Okay. Mr. Paul, there you go. I'm sure everybody on the call today has heard of the Old Capital podcast. You know what? We have 65,000 listeners now. Thank God for COVID. We went from 50, I think, to 65. So we're really just knocking it out of the park. And you know what? You always get a nugget when you listen to this podcast. We're listening to real live investors who are doing it, who have, gosh, I think that, you know, let's see, I was on one just a couple weeks ago, but, you know, we heard just recently from a couple of our customers in Dallas, and it's just so fun to hear, even though it's not fun to hear, their challenges that took them through from start to finish. So, you know what, it may not be something that you can understand, but when you're in it, you will understand exactly what it takes to get into these deals. So we talk about multifamily, we talk about, you know, lending, we talk about attorneys, the ones that we like, we talk about, you know, how to do due diligence. At any rate, there's lots of education on this program, and I think it's really worth it. This is Paul Peebles on the left. He is our national underwriter, and Michael Becker is with SPI Advisory. Two very smart guys, and really have a lot to share with you. And then our last is that we do a national conference every year. This would be our 4th year, but we don't know if we're going to have anything because we cannot gather, apparently, in the great state of Texas. But this is a one-day conference, and this is all about education. This is not like, hey, I want to show you how to get rich quick. There's no money exchanged. It's about education. So you're going to find partners for your team. There's attorneys. There are property managers, there's insurance brokers. There's a lot of knowledge and a lot of networking in this one-day event. So you can see we had Rob O'Neill, who was with SEAL Team 6, who took out Osama bin Laden, Osama bin Laden, and he talked to us about teamwork. I know. Shh. And then Roger Staubach, who, you know, you guys know better than me. He came to talk about getting in the game. And then Lou Holtz this year, wow, what an amazing speaker. 83 years old, came and talked to us for about an hour with no teleprompter, no notes at all. And what an amazing amount of knowledge, and just shared so much wealth of information.
He was awesome,
So
Julie.
he really was
I got a
really
signed
good.
football from him, or a signed helmet from him. He
Oh,
talked to everybody, to a group of people at the end. Unbelievable story. I mean, aside from
yeah.
all the people and everything else, to get speakers like that's incredible. I really do hope that if it's going to happen, Texas is the place where it should happen.
Yeah,
But
I would
I hope
agree.
you guys do it again.
We will. I hope, you know, if it's not this October, we'll get back on track for next October. But really, I can only stress that this is the conference to go to. It's really worth the time, the money, and the energy. Okay, so if you have any questions, www.oldcapitalconference.com. Keep that in mind. That you won't find much there now, but when it comes up, that's where you'll go. And so that's how to contact me. I answer my phone, I want to say 24/7, but I do sleep a little bit in there. I'm easily, you can easily reach out to me. I'm on Facebook. I've done a lot of contacts on Facebook. It has grown my business tremendously. So if you're not on Facebook, I highly recommend it. It's a great place to meet any of your syndicators, you know, deal sponsors, you know, limited partners, for heaven's sake. So I'm just so excited to be here. I'm thankful. I'm really thankful that I got the opportunity to share what I know with all of you. And Trevor, thank you so much for being here. If there is any questions, we would be open to them now if everybody is still awake.
They're awake and we have questions.
Okay.
Do you want to unshare your screen so we can?
I can do that.
You're the best.
Thank you.
So, Cindy, did you get a chance to look through some of the questions? And by the way, you can ask questions right now as well. Put it in the chat box just to make life a little bit easier. Cindy's going to go back through. Let's see. Yeah, so.
Oh my goodness, 43 in the chat box.
Yeah, it's just a few questions.
I think I got to get my hair cut in about 10 minutes.
It's people. You're fine. Are you kidding me? What time is it there? 9 o'clock p.m.?
No, we go backwards, dude.
I know, I'm kidding.
5:15, yeah.
Here's a good question. If you bring liquidity, how long does your money need to sit in the bank doing nothing?
Doing nothing.
Trevor?
So typically that's a snapshot, but we do want to know that it's post-closing liquidity. Just be careful. Some of the pitfalls of that, folks like to make the argument, well, you're going to give me a cash out loan, so then I'll have liquidity. We like to see it before and after, but we don't require, there's no seasoning requirement.
Should I keep going? Yeah.
Yeah.
How are lenders?
One more. No, just kidding.
Okay. How are lenders underwriting for rent growth during this time? Is everyone assuming a flat rent growth for the entire year?
You know, I have heard people as much as 3 years. No rent growth.
That's encouraging. That's encouraging. Thanks, Julie, for those encouraging.
Well, you know what? I'm sharing. I don't mean to, I care and share.
I like this one. Merrill for president.
Yeah.
Oh, yeah.
Oh, yeah. The politically correct American.
President of Facebook. Yeah.
No, yeah. I didn't make a comment about you saying, "Oh, Facebook's wonderful, wonderful," after I started the show with.
Oh, that's right. Sorry.
Yeah. So it's good for certain things.
Yeah.
Listen, and Trevor, I apologize. When she said Wells Fargo, I did not realize you were also doing Fannie and the other loans. So my apology.
We do a lot of this and that, but our multifamily capital group is like one of the largest in the industry. Fannie, Freddie, and Hud, and with Old Capital's help, they've really grown our business together. It's nice.
So you bring up an interesting topic, not an entire evening, but real quick, HUD loans. So I saw a deal come across our desk. We are syndicators as well, and it was a HUD loan, an assumable HUD loan. I believe it was a 35-year term at a ridiculously low rate.
Mm-hmm.
This one, I want to say it was like 283 or 285.
Yep.
But my concern was, and I believe it's correct, you can't get a supplement on top of a HUD. Is that correct?
You cannot do a supplemental loan.
So you're kind of you're pretty much banking on, you're not going to get a whole lot of, well, you may get some rent growth on a HUD loan, but most HUD loans are tied to low income housing.
Not necessarily. In fact, they just opened the door for Class A brand new construction. Usually there was a 3-year seasoning requirement. They will now take waivers of that, so it doesn't necessarily have to be associated with some sort of affordability. I will say HUD loans are just a different animal, and a lot of times it's relative to timing. On acquisitions, they're very difficult to do because they take 5 or 6 months to get done, and so there's not a seller out there that really wants to wait 5 or 6 months in escrow. There are folks who will do bridge to HUD. We will do that selectively to get an acquisition done into a HUD loan. Rates for the HUD loans right now are probably closer to 2.5. Then you have a mortgage insurance premium on top of that. 60 basis points if it's not a green deal or doesn't have affordability. So really you're, call it 310, but it's 35-year fully amortizing money. And it's, I would say, great for refinances. And if you can get somebody to give you time, it really is a fantastic product. It's a little quirky, but, and it does have a more flexible prepay. It's step down. We either do 10-765, 10-9-8-7-6-5-4, 3-2-1, and then open on a 35-year term. We can do lockouts and then step down. So kind of all depends on what you're looking for. But to have it be fixed that way, it is flexible. They are easily assumable. So if you do find one, find a property that's tied to one, most folks shy away. They say HUD's going to be too difficult and too time intensive to get that done. Actually, assumptions with they call it a TPA, or transfer of physical assets, really doesn't typically take more than 2 months. So just like a regular escrow. So, but it's not for everybody.
So we have another question from some guy named Merrill. And I'm not sure which
We're
one
not
of you.
taking his questions.
Oh, it's a good question.
Okay.
If I don't mind saying so. So what do you do, and maybe this is a Julie question, and Trevor might have an answer too. What do you do when someone comes to you and actually wants to do ground up, new construction?
Mhm.
Is that something you guys are working with? Because
Mhm.
Merrill happens to be looking at a project, not a big
Yes.
one, 100 units in the DFW area. What kind of financing structure are you guys recommending or seeing in this economy? Again, a market like DFW that is, like, I look out my window and there are 8 cranes that are over 25 stories, far north Plano. So, I mean, clearly there's building and people moving and traffic right now, a little different than the rest of the country. But what do you guys suggest? I have a couple clients also looking at some new construction as well.
Yeah, we're doing one. We just closed. We're closing one in Texas, and closed right around, like Trevor said, right around low 3s. And now
So-
you do need to have your construction guy has to have experience in that.
Right.
So you just got to make sure that all of the I's are dotted and T's crossed. I mean, there are things that you got to be aware of, and certainly we can go into that on another time, because
Sure.
there are requirements. You have to follow the rules, and there are inspections. And Trevor, you can certainly take a minute on this, not to bore everyone, but there is opportunities.
Well, that's,
I think-
before Trevor, before you, so let's just, before you answer, let's assume that you've got an experienced team, and it's more about, is it recommended we just go ahead and buy the land first and then get the loan? Or are groups like you guys, you and Julie, when you guys work together, are you looking for financing on the whole package, or is it some sort of interest only, convert to perm? What are we generally looking at?
You know, for the ones that we're looking at, we did purchase the property first. So I can speak to that. Trevor, where are you at with that for, you know, on buying them separately or together? I know we have done both, but what is your set?
So typically you'd want to get control of the land first. Because especially if you're looking at doing a HUD construction loan, because those take quite a bit longer to do. And let's just say you'll be lucky to get it done within 10 months. Most typically it's about a year to get one of those done. So you're going to want to get control of the dirt, go through the entitlement process if it's not already that way. Because it is such a heavy lead time. I can tell you, like most balance sheet lenders, we're being extremely selective about how we would do a conventional land loan or construction loan. I'm seeing more local banks dabble in that than I am the larger banks, unless you are a deeper repeat customer of Wells Fargo. In all likelihood, construction finance is not going to be in the cards. But the D4s are very popular in those sort of middle markets. So the 221 D4 works really well in middle markets. So something in the central space, even further back east. When you get into areas like California, or even, let's call it Western Seaboard, it's very difficult to make those pencil because they do have requirements for prevailing wage labor, which is about market when you're in Texas. But when you're here, that can raise your cost by almost 35%, which is no fun if you're the developer. But we see it happen a lot, and folks use that product to develop quite a bit back east. You just got to be careful too. One of your comments was about, hey, you got cranes going up everywhere. And HUD is very sensitive to that, to absorption, oversupply. So we see larger projects can occasionally be divided into two. So they require phased building. 150 units should be fine though.
So on HUD, what are you quoting on HUD loans right now?
On a construction loan, it's just under 3%.
What's your LTV on that, Trevor?
And well, technically you can do 80%, but you can 90 if it's got affordability. Yeah. And what I can tell you is if you buy the dirt right, the way that they value the land, they value it at market. So if you got a good deal or you've been sitting on that dirt, we have customers who don't come in with a penny occasionally because we're lending against that land value. But it's a 42-year loan essentially, right? You got 2 years of construction IO and then a 40-year permanent, right around, call it around 3%. Let's hope it stays there for the next year, but because that's about how long it takes you to lock the rate on it. On the construction.
As opposed to a bank loan that's at 65%, you know, so I mean, it is a great option. Really, really good option.
Yeah, the customers that we have that do it they do very well. The ones that have it as a program.
Julie, I may be having to call you soon.
You call me. Call me.
Oh, don't sing.
Okay.
What else you got, Cindy?
Oh, okay. Let's see. There was a good one up here. Hang on. Oh, okay. For first timers, is taking on a KP role on a deal, does it bring greater or equally or less credibility for future deals with lenders? Or is it better to find a deal and partner with an experienced sponsor?
So Trevor, do you understand? The question is simply a good portion of the listeners here and some of the other Facebook people are members of investment clubs. And part of what the investment clubs teach is many times is to be a KP first, someone who's got the financial net worth, but not the experience. And by being a KP, Fannie, Freddie look at you better when it comes around to the next deal because they've already seen you in the books, as a bad boy, bad girl guarantor on a deal. So I think what they're asking is, they want to hear it from the lender's mouth, so to speak. Is that true? Is it not really that important?
It is true. It certainly doesn't hurt. And we like to call those investors emerging players. So we are careful about who we're doing business with. I mean, we're making non-recourse loans, but we get to know our sponsors. I can tell you just from, my career, the only time I've come close to taking a loss was when we didn't pick the right sponsorship. It really wasn't the property. It really wasn't the market. It was just the wrong people. So we're careful, but I think it is much more difficult to step into a KP role without having ever done it before than it is to get in with folks who have.
Julie, comments?
The KP is with a lot of the local folks here outside of the great state of Texas. People look at me like, what are you talking about? So, a lot of people say, well, I'm a KP, but I have to bring money in. I got my net worth, but I have to bring money in. So there's just a little bit of a different understanding of it. I'm always trying to get people to do more of be a GP if you can. I just feel like there is more power in that if you can. But
Yeah,
I understand it. I understand it.
I agree with you. And for those people that aren't familiar with the term KP, it's a key person. It's more of a term of art by some of the investment clubs. And so it depends on how a particular sponsorship or syndication is structured. Sometimes they will, syndicators will tell you, okay, if you come in as a KP, that gives you credibility on the next loan or two loans down the road. You don't have to put anything in, but the bonus of you being a KP and putting your financials up is you get credibility. Other sponsors we have will actually give either a piece of the GP or a piece of the LP, even if we're talking LLCs, people just go with GP and LP terms. Mm-hmm. But they'll get something for being the KP. But outside of the investment clubs, that's really not a term that's used. Mm-hmm. Typically, the GPs get together and collectively their financial net worth meets the requirements, or they go find an additional person, like Julie said, who is part of the GP. The reality is they're bad boy, bad girl guarantees. And so unless you're committing fraud or an intentional tort, which can be the same thing, it's not going to be an issue with you as a KP. You're basically kissing a note that's probably not going to be an issue. But that's good. That's really good information to know. Guys, we have the money. Anybody have any more questions for the money? The money is sitting on the table. Julie has shown you the money. Show me. And by the way, Trevor, I'm going to use emerging players in some of my
or partners.
Players. Sorry, I put players, partners, emerging partners. I like that term better than KP. Like a PIT, partner in training. You like that?
Yeah.
As opposed to a PITA, which is a pain in the.
Yeah.
Yeah. So you can go from a PIT to a PITA depending on how you behave.
Yeah, true.
Yeah.
You might reside in that PITA, but yeah.
Yeah, you are a PITA.
Yeah.
But you're my favorite PITA.
Okay, I'm good with that. I'm all right.
Yeah.
Thank you.
And if there are not a whole lot more questions, one thing we're going to do is we're going to provide this recording to everybody that RSVP'd. So luckily, Julie's information is on the end of the recording. Roxy, who's on, will also provide in the email with Julie's information, how to get a hold of her, and Trevor's personal home phone number and cell number. If you get a hold of him.
No.
I'm
if
kidding.
You need to talk to Trevor, you call me. I'm your person. I'll take care of you.
I know. And guys, just again, I want to stress, it's rare that we get, I've only had one other time where we get a true lender on with a mortgage broker. So I really want to thank you, Trevor. I didn't ask you, didn't even know you were going to be on. Julie told me at the last second, and I really appreciate you being on. You guys together provided some, you're welcome. Some great information. Again, we use Julie and Old Capital. Many clients use them. They are straight shooters. Highly, highly, highly recommend you guys take Julie up on her offer to talk to her when you're just starting to look at a deal, because Julie and her team will help you decide whether the deal pencils right or not. It never hurts for a second set of eyes, and quite honestly, those are free eyes. That's part of their, quote unquote marketing. Like, we do free LOIs for people. We want you to get it done right before you get into the deal. So
we want to tell you the bad stuff up front, so you know what the challenges are before you get to have to retrade it, or you just get too far into the deal and lose the money. That's not worth it. It's not good practice.
Yeah, the unique thing about Old Capital, and I've talked to Paul a couple times because he's here in Dallas. I've talked to him. I've known Paul for 12 years. Is they're around and have been around long enough, kind of like Trevor. You guys are kind of giving your ages out when you say how long you've been in the business, but you've seen deals trade, retrade, and retrade. So
yeah, and we've been through downturns, so we know how to get the deals done. We see the bones where they lie and how to get through those maybe difficult things, right?
You say bones, I would say I've been warned of a couple skeletons in a nice way that I would not have known had I talked to your team. And so, good or bad, it made me decide not to go that direction. And that's invaluable. The fact that you guys, obviously you can loan to anybody who qualifies, but you guys are looking for long-term partnerships. And it doesn't make sense to try to get a fee or, a point or whatever the number is to get the deal done. You want people to continue to come back. And that's why both of you have been in the same industry for so many years. You guys develop relationships. I mean, we look at our clients really as partners in business. And I think you guys do the exact same thing. It's very nice to know you guys don't hustle, you don't pressure at all, and you give great advice and great options. It's not just this is the only thing. You give everybody 3 or 4 options, and you sit down and you walk through them, or you do it over Zoom like with us.
It really doesn't matter. At the end of the day, it's about closing the loan. You spent all of this time trying to find a loan, to try and find a property, to get a loan, to get your investors, to get, your LPs all set up. And the worst case would be to lose the loan or have to retrade it and go back and have to get more money. That is the worst deal. So maybe you hear that somebody's going to give you 80%, and we've been down that road. We know the situation, and it's only at 75, but this guy's telling you it's 80. You got to think about, what's really going to happen. We've heard people say that this does happen, where right between the time they close and the time they've got the commitment letter, that they find out that, oh no, I need to get some extra money. And now you say, well, I was getting a better deal with this other guy. Well, you know what? We can see that. We know it. We've been there.
Worse, Julie, it doesn't close.
Or it doesn't close.
The last second they can't do it. And again, I started your introduction off by, you guys make them close. If we haven't had clients where you guys have given a commitment, and yes, sometimes the terms change because you are 45, 60, sometimes 4 days out, but you guys have the relationship with the lenders, you get it done. And there's a lot said for that. So it's kind of like when we talk to people about choosing their lawyers and choosing insurance, and I can save $1 here. You're talking saving hundreds of a penny to incur risk that is unnecessary. So yeah, and by the way, you guys aren't the most expensive in town. So that's the other thing. Not only not the most expensive, you get the deals done. But you may hear some really bad jokes from Julie. in the interim, but she tries. She really does.
I do.
I
It's
didn't
okay.
I didn't let
That's
you
all
put your picture up of you and your husband's tattoos because I thought that might scare some of the.
Yeah. Yeah, I know. I took that out just to save you.
Yeah. So listen, I want to thank everybody. I
You want to see
know.
it. You didn't want to see it.
Yeah, appreciate that. I know everybody has other things going on, and again, thank you, Julie and Trevor, and everybody else for
Thank
being
you.
on. And if you have more questions, PM me. I'll forward them on to Julie, and hopefully, Trevor, you and I'll get to do some business together in the future through Julie.
Yeah.
Thanks very much.
Thank you a lot, guys.
Thank you, everybody. Appreciate
Take
it.
care.
Take care.
Hi, Julie.
Bye-bye, Cindy.